Okay, it is currently 1:41 a.m. I think I've been working on this since about 9. I've learned a lot in the process. I hope you will as well by the end of this video. This might be a slightly longer video, so this homework that we got for week 6 did seem to drag on a bit as I was doing it, just because there's a lot of information and steps to follow and it's easy to make a mistake. Cool, let's get into it. So the first question that we have to do, let's just go to the end. What do they want us? They need us to calculate the net present value of the project and advise the company on this basis whether it should undertake the project. Cool. So just a few notes when it comes to calculating net present value. If the net present value is greater than 0, you accept the project. If not, you obviously don't. So what's our first step? Firstly, let's identify our non-cost items and our sunk costs. So the first sunk cost you can identify here is the marketing survey, which is 120,000 Rand. The non-cash item that you can identify, let's go to point 8, is this fixed costs allocated from head office amounting to 440,000 per annum for each of the next 3 years. So those are our sunk costs and our non-cash items. Second step, let's ask ourselves what's our initial investment. That's obviously the cost that we have to justify by discounting the future value we get from the investment and then seeing if it's worth it. So what they tell us here is that there's a machine that costs 5 million. If you go to point 3, the new machinery required for the project will be 5 million. The working capital required is 400,000. That's over here, point 6. Working capital of 400,000 will be required on commencement of the project. So that tells us that in year 0, the cash flows or the cash outflows is negative 5.4 million. So that's the second step. Okay, so the third step, let's calculate our annual operating cash flows. So they give us the net profit pre-tax. Let me just go down here. Okay, so for 2015, the net profit before tax is 825. It's 975 for 2016. It's 1125 for 2017. Then depreciation is the same in each year. It's 1,300. I'm assuming this is in thousands. So when I say 1,300, that means 1.3 million. 440 means 440,000. And so they also do calculate for us the net operating cash flows. So that's the third step, calculate the annual operating cash flows. And you guys know where to find it. I'm assuming you also have this open, the PDF of the question. So step 4, what's our terminal cash flow in year 3? So the residual value of the new machine is going to be 1.1 million at the end of when we're done with the project. So if we go to point 4, the new machinery will have a residual value of 1.1 million. So that's what it's worth. So if we want to sell it in that year, we probably will, we can, because the project is done. Then recovery of working capital is 400,000. So the way this works is, we use working capital when we commence the project, but when we stop the project, we free up that working capital and we can use it for other things. So it counts as an inflow. So we get that back once the project ends. Okay, step 5, let's calculate our opportunity costs. So go to point 5. They tell us that the new product is expected to cannibalize or take away the pre-tax cash flows from another product of 15,000 Rand per month over the next 3 years. So negative 15,000 Rand times 12 is negative 180,000 Rand a year. So that's our opportunity cost from the project per year. So step 6, now we're working out tax. This one is a bit of a loss. It takes a bit longer, but okay. So we're given the weighted average cost of capital in point 11. It is 15%. And in these questions, we use that as our discount rate. So we know that the machine cost 5 million Rand. Okay, so what are we going to do now? So now we want to figure out what the wear and tear allowance is, because remember, we can take the wear and tear allowance and subtract it away from our taxable income. So it's not fair for me to be taxed on something at 5 million Rand when it's worth less. So if we go to point 7, they tell you accounting depreciation is calculated on a straight line basis over the estimated life of the product, and for tax purposes, SARS allows section 2012C wear and tear allowance on the 40-20-20-20% basis. So that's per year. So in year 1, 40% wear and tear allowance. So the 5 million is what the machine is worth. So after year one, 5 million, or I guess in year one, we're not in year zero, we're in year one now. So 5 million times 0.4, so we subtract negative 2 million. So at the end of the year, the tax value is 3 million. For year two, 5 million times 0.2 is negative 1 million. That's what we can subtract. So the tax value at the end of year two is the 3 million minus the 1 million. So the 3 million is the tax value at the end of year one. And we have to take the tax value at the end of year one, bring it to year two, and then subtract the wear and tear allowance for year two. So the taxable tax value year one is 3 million, year two it's 2 million, and using the same logic it's 1 million for year three. And then so note in year one we have a wear and tear allowance of 40%, and then year two and three we have it at 20%. Let's quickly calculate recoupment. So recoupment in year three, if you go to 0.4, it has a residual value of 1.1 million at the end of that. Now, what we've calculated here is that at the end of year three, it has a tax value of 1 million rand. So what does that say? So it says that, okay, SARS tells us you owe us 1 million rand on the basis of your ownership of this equipment. That's what's taxable after you've deducted your wear and tear. But now we're selling it for 1.1 million, or that's the residual value. So that 100,000 rand is taxable income. So it's essentially a correction for an over deduction from SARS. So what you now pay, given that the tax rate is, it's always 28% in these questions, but they give it to us as well. So you pay 0.28 times 100,000, that gives you a 28,000 rand outflow, right? So that's your recoupment in year three. So let's move on. So what we're going to do now is we're just going to quickly calculate our tax payable. So you'll see in the description here, I have net operating cash inflow. That comes from 0.9. They give it to us. They ask us what is this amount called. It's called net operating cash inflow. So for year one, 2565. For year two, 2715. For year three, 2865. Our opportunity cost, which we calculated, or which they also tell us, is 180,000 rand a year. The wear and tear allowance, so we've calculated that to be, it's 2 million for year one, 1 million for year two, 1 million for year three. You can just go back. We already calculated it. So just to show you, so we calculated it 2 million for year one, 1 million for year two, 1 million for year three. Cool. And then in terms of recoupment, so that's what we also need to add. So we calculated that as 100,000 rand. And so when we add all of that up, we have a taxable income of year one of 385,000, 1,535,000 for year two, 1.535 million, and then 1.785 million, or 1,785,000, whatever, for year three. So you multiply that by 0.28. So we have a tax payable of year one, 107.8, year two, 429.8, year three, 499.8. Okay, we've done that. Now we are on to the final step. So now we're just doing the net present value schedule. So what we're basically doing now is we're putting together all the cash inflows and outflows, and then present valuing it, and then we can make a decision on the basis of whether or not the net present value is positive or negative. So for period zero, that's just where we, that's where we lose money, that's where we invest. The machinery cost us 5,000. So this is also in thousands, so don't get confused. So when you see 5,000, add 3 zeros, it's 5 million. So machinery is 5,000, working capital is 400. Our total cash flow is thus negative 5,400. So everything you see in brackets, that's negative. So we present value it at just 1, because if you say 5,400 over 1.15 to the power 0, that's just 1. So the present value is 5,400. So for period one, we don't buy any machinery, we don't have residual value of machinery that contributes as a cash inflow, and we don't have any outflows in terms of working capital. We don't we don't invest further in working capital. We just keep what we retained in year zero. So the net operating cash inflows, 2565, they gave that to us. The opportunity cost, we calculated that, but it's very simple. The tax, we calculated it. So just note op cost and tax is both negative. So that gives us our total cash flow of 2277.2. If you present value it, so use the discount factor of 0.8696. So that is to say, if you say 1 over 1.15, you get 0.8696, round to 4 decimal places. And if you if you multiply that with 2277.2, you get the present value of 1,980. And the process just continues it's exactly the same for year 2. You can have a look there at the values, but we get a present value of 1592. Just to note, remember when you present value year 0, it's 1 over 1.5 to the power 0. When you present value year 1, it's 1 over 1.15 to the power 1. Year 2, 1 over 1.15 squared. Year 3, 1 over 1.15 cubed. And what I've done here is I put that in my calculator, and then whatever I get, it'll be a bunch of decimals. I round it to 4 decimal places. I think that's also generally what they want you in the tests and the exams to do. They'll want you to round your calculations, your intermediary calculations, to 4 decimal places. So just remember that. You might have a small error if you're too accurate with your decimal placing. Then just check year 3, residual value of machinery is 1,100, and that's what they tell us in the question. Working capital, we get that back, right? So it was an outflow in year 0, it's an inflow in year 3 because we finished with the project, so we get that back. And then yeah, your net operating cash inflow, your opportunity cost, your tax, all of that is very nice. We've already calculated that. That gives you a total cash flow, and you just present value that. Now we just add everything up. Negative 5,400 plus 1980 plus 1592 plus 2423. That gives you a positive 595,000. So you accept the project. So if you invest in the project, the net present value of the project is 595,000. Sorry, it's too late in the day for me to speak properly. But yeah, so we accept the project. We're done with that question. Okay, let's go to question 2. This is quite a dragon. This whole homework thingy took me a long time to figure it out, but dragons are there to be slain. So question 2, prepare a schedule using the net present value capital budgeting technique and decide whether or not Mogidi manufacturers should replace the machine. So similar to the previous one, what's our initial investment? So the new machine costs us 14 million. So the old one cost 12 million. The new one costs us 14 million, and the additional cost of transportation and installation cost is 1 million. So it costs us 15 million to have the machine in the factory or whatever. The sale of the old machine, if we embark on this project, that's what we'll do, gives us 2.9 million. The initial working capital that we require for this is 1 million. So I just want to check where they tell it to us. Yeah, the firm would require working capital requirements in the form of raw material inventory of 1 million when the machine is ready and available for use. So in year 0, when it's available, we need an outflow into our working capital of 1 million. So the net initial investment is the negative 15 million of the machine and its installation, plus the 2.9 million we get from selling the old machine, minus the 1 million in working capital. That gives us negative 13.01 million. So let's quickly calculate our pre-tax annual operating cash flows. So all the numbers here are shown, so I'll quickly just show you where we get everything from. So the increase in sales, they tell us that the new machine will be super dope, and so increase in annual sales will be 10 million in year 1, 8 million in year 2, 7.5 million in year 3, and in year 4 the increase will only be 7 million. So you'll see it here in year 1, 10, 8, 7.5, 7. Cool. And then the production costs, I'll quickly show you how we work that out. But at the end of this, we will have our gross opening cash flows. How do we work out the production costs? So I think they give it to us here, if I can just find it. The production cost comprising cost of sales and fixed costs is estimated to be 70% of the annual increased sales amount over the 4 years. The fixed costs include the annual depreciation on the new machine and company allocated cost of 1 million rand per annum. Cool. So how do we now calculate our production costs? So we know it's 0.7 times sales, simple enough. So you'll see for year 1, it's 0.7 times 10, year 2, 0.7 times 8, year 4, 0.7 times 7. That's obvious. Minus depreciation. How do we calculate depreciation? We're using the straight line method. So what you do is you take 15 million rand. That is the, I believe the, what is that? That's the residual value of the equipment, or it's what you paid for the equipment. It's what you're going to discount to SARS. So it's 15 million rand. You subtract the 3 million, which is the residual value at the end of the 6 years, and you divide that by 6 because it's got a useful life of 6 years. So I just want to show you here. So the new machine is expected to have a useful life of 6 years and a residual value of 3 million. So we use the straight line depreciation method. So that gives us depreciation of 2 million rand a year. So 0.7 times our sales minus our depreciation each year is just minus 2. Minus the allocated costs each year, we subtract 1. And then in year 2, year 3, and year 4, we are going to subtract 3 as well. Where did we get that 3 from? Sorry, I made these like a while back, so I just want to quickly check where I got that from. Usually when I make a mistake like this, I just restart the video, but I am too tired to do that. Okay, for now, I'm not quite sure where I got that from. We'll get back to that. But yeah, then you get these values for your production costs, a value of 4, 2.6, 2.25, and 1.9. And then that'll give you your gross opening cash flows. Then step 3, we have to look at our working capital requirements. So they tell us here, if I can find it, hey, I'm too tired. Okay, so the firm would require working capital requirements in the form of raw materials, inventory of 1 million when the machine is ready and available for use, 2 million in year 2, 1.5 million in year 3. Okay, so that means in year 0, we have R1 million. From year 0 to year 1, we increase it by 1 million. From year 1 to year 2, we decrease it by 0.5. From year 2 to year 3, we decrease it by the full amount of 1.5 million. And then in year 4, there's no change. So that's step 3. We've calculated the working capital requirements. Step 4, let's calculate the terminal cash flow. So the terminal cash flow is the residual value of the new machine. So that will be the 3 million. Step 5. Okay, so now we're going to calculate our tax. How are we going to do this? So firstly, look on the left-hand side. So we have the increase in sales, year 1, year 2, year 3, year 4, that we already calculated. The production costs for each year, which we already calculated. So adding those up together gives you your net operational income. And then for each of those, you subtract your wear and tear. So your wear and tear allowance in year 1 is 40%, because 40%, is 40%, and 40% of 15 is 6. The wear and tear allowance in year 2, 3, and 4 is 20%. 20% of 15 is 3, so we put 3 there each year. Then for year 1, another thing we have is the lost allowance of the old machine. So when you sold the machine instead of still having it, so you can't subtract, you can't claim it back from SARS anymore. And then recoupment. So why does that add to our taxable income? So the idea here is you discount it using wear and tear allowance. So 12 minus 0.4 times 12 is 7.2. 7.2 minus 0.2 times 12 is 4.8, because in the question they tell us that the old machine cost 12 million. So you discount it for each year. So year 1, year 2, year 3, and we're selling it in, I believe, year 3. Oh, we're selling it now, sorry. So when we sell it for 2.9 million. And I think they tell you that, so we sell it for 2.9 million. But what we've done here is we've shown that the wear and tear allowance means that it currently has a residual value of 2.4 million, or that is the taxable value of the old machine. So the taxable value of the old machine is 2.4, and we sell it for 2.9. So we can subtract the 2.4 from when we sell it, but we still owe SARS the 0.5. That's our recoupment. Okay, I hope that makes sense. And then in terms of taxable income, it's the 2.9. So the 2.9 is just what that's how much we sold it for. And then the tax here is a 28%, and so that gives you 0.81. So 28% of 2.9. So yeah, for year 2 and year 3, they are just plug and play. So what is our increased sale value? We already calculated. Production costs already calculated. Net operating income is the sum of those two. Wear and tear, we know how to calculate that. All of that together gives us our taxable income of 2.4 and 2.25 respectively, and then you tax that at 28%. It gives you a 0.67 and 0.63. So that is 28% of 2.4 is 0.67, 28% of 2.25 is 0.63. And then year 4, same process, but we have recoupment of the new machine of 3. So that is to say, when we look at how we use the whole wear and tear allowance thing, so in year 1, we say 15 minus 0.4 times 15, that gives you a value of 9. Year 2, you do that, gives you value of 6. Year 3 gives you value of 3. Year 4 gives you value of 0. So when we sell it for 3 million, it's just, I guess, pure tax profit, if you want to call it that. There's nothing to take away from it because, you know, it's, I guess, technically worthless. So the recoupment in that year is 3. And then, so you add everything up for that year and you get 5.1. So you tax 5.1 million at 28%, you get 1.43. Okay, so let's move on. We've done our taxable income. Okay, so now this is now the big dragon. But this is really just us putting all the information that we already have into the net present value schedule. So I hope you can see it semi-clearly. So for year 0, our initial investment is 14 million. We add the costs of 1 million. So again, if you see brackets, it means it's a negative, it's a cash outflow. If you don't see brackets, it's positive. We sell the old machinery, that gives us 2.9 million. We have a working capital that we need of 1 million. That gives us a subtotal of 13.1 or negative 13.1. So the net cash flow for year 1 is 13.1. We present value it, but because it's in year 0, it's just the present value factor is just 1. So the present value in year 0, I guess the cash flow in year 0 present valued is 13.1. And so we repeat that process for year 1, year 2, and year 3. So we just put in our operating cash flows. We check out our tax that we calculated previously, figure out our net cash flow, present value it, depending on the year. So either 1 over 1.14 or 1 over 1.14 squared, or 1 over 1.14 to the power 3, or 1 over 1.14 to the power 4. So then we use that present value factor, we discount our net cash flows, and we get the present value for year 0, 1, 2, 3, and 4. Yeah, so your operating cash flows, we've shown where we get that from before. Your working capital is, maybe I should mention something about this. So the working capital is the difference the amount of working capital you add each year. So remember, we need 1 million in year 0. And then in year 1, we need 2. So that means we spend another million on working capital. And then in year 1. And then in year 2, we go from 2 to 1.5 million. So that's an inflow of 0.5 because we, I guess, don't need to use as much working capital. And then the 1.5 million goes down to 0 in year 3. So that's why working capital over there is 1.5. It's a cash inflow. And so, yeah, increased sales, they give to us the production costs we calculated previously, the residual value of 3 million in year 4, because that's what you can sell it for, and then the tax that we already calculated, and then we got everything. And then all there is to do is to add it up. And so because we have a positive value for our net present value, so adding up negative 13.1 plus 3.68, etc., gives us 2.56 million positive. So the decision is to replace the old machine. I just want to quickly go back to the production cost because I remember I couldn't fully figure out one component of it. I'm not sure if I'll remember it. Maybe I was too quick in making the notes. I'd recommend you maybe just skip forward in the video in case I don't figure this out. So it's 0.7 times 10 minus the depreciation minus the allocated costs. I just want to figure out, if I say 0.7 times 8 minus 2. Oh, okay. I see why I have confused myself here. Because there is no reason for the 3 to be there. Okay, so the mystery has been solved, ladies and gentlemen. I just added a 3 in there for vibes. So ignore that. Great stuff. Now let's move on with our life. Okay, so we've done question 1 and we have done question 2. I hope everything has been clear. So we figured out our tax, we made sure to do the recoupment, to add our lost allowance, we did our wear and tear, and then we put everything in the net present value schedule, and then we present valued everything, and then we got a net present value which was positive, so we made the decision to replace the old machine. So we're moving on now to the textbook questions. So it's 206. Sure, yeah, it might be a bit of a long video. My apologies. So the textbook question, the first one, 10.4. So this individual, Confettiere Agostina, from a miscellaneous country, probably Italy, is looking to purchase a new jelly bean making machine at a cost of 312,500 euros. I'm just going to use Rand because that's the currency we all know and love. The company projects that the cash flows from this investment will be 121,450 for the next 7 years. If the appropriate discount rate is 14%, what is the net present value of this project? So what do we know? We know the machine costs 312,500 Rand. The cash flow is 121,450 for the next 7 years. So n equals 7. The discount rate is 14%. So how do we calculate net present value? What we do is, so we say sum or sigma, t equals 0 to n. So the cash flow in year t over 1.14 to the power t. 1.14 because our discount rate is 14%, right? 1 plus 0.14. And so the way you calculate this is you first say, well, what is our year 0 cost, or what is our year 0 cash flow? It would just be the negative 312,500 over 1.14 to the power 0, because that is in year 0. Then it would be 121,450 over 1.14 to the power 1, because that's in year 1, all the way up to year 7. So 121,450 over 1.14 to the power 7. So the answer you get there is a positive 208,315. And so if they were to ask you, should they do this? You would say yes, because the net present value is positive. Question 10.6. So let's try this. Let's try this name. Norge Specialiteter. Okay, let's leave that. That individual just purchased inventory management computer software at a cost of whatever that is. We're just going to use Rand. Cost saving from the investment over the next 6 years will be reflected in the following cash flow streams. What is the payback period on this investment? So again, let's pretend it's Rand. So let's just check yearly. So in year 0, we have 1,645,276 negative. That is how much what is it that they're buying? That's how much the computer software is costing them. Then in year 1, they have a cash inflow of 212,455, and all the other cash inflows from the PDF that they give you are listed here. So these are all the yearly cash flows. On the right-hand side, we have the cumulative cash flows, I guess. So it's a negative 1,645,276, and then you, I guess, add a positive number to a negative number, so it becomes slightly less negative. And so that gives you 1,432,821. And so we keep doing that until you'll see by end of year 4, there's still, I guess, a cost of 236,604 that has to be recuperated. But at the end of year 5, we're actually in the black. We've made a profit of 409,664. So in this question, what they're asking us is what is the payback period on this investment? So that's essentially how long does it take, given these cash flows, how long does it take you exactly to pay back the initial cost of the investment? So at the end of year 4, we owed 236,664, but at the end of year 5, we are we've made a profit, I guess, of 409,102. So note as well, we're not present valuing anything, because we just want to know in dollar terms, in Rand terms, have we paid back the investment? And so the way we calculate this now is we say, okay, so we know that the payback period is between 4 and 5, because it's not 4 because we still owe them something in 4, but it's not 5 because by the time year 5 ends, we've got more than enough profit. So to calculate it, you say 4 plus the remaining costs over the cash flow during the year. So the remaining costs at the end of year 4 are 236,664. And then the cash flow during the year in year 5 is a positive 645,766. So 4 plus that division gives you 4.37 years to 2 decimal places. So that is the payback period. Let's go to question 10.8. So question 10.8, Clariol AG is expecting to generate after-tax income of, let's just use Rand, 63,435 Rand over each of the next 3 years. So each year, the after-tax income is identical. The average book value of its equipment over that period will be 212,500. If the firm's acceptance decision on any project is based on an ARR of 37.5%, should this project be accepted? So we know that the after-tax income is 63,435 for 3 years. we know that the average book value of equipment is 212,500, and the required or the desired ARR is 37.5%. ARR stands for stands for accounting rate of return. But we all, we're studying finance. We don't think accountants are cool. Well, some of you might be studying accounting, but in that case, you're just not cool. Otherwise you'd be studying something else. So the question is, do we accept or reject this equipment? So the way we calculate ARR is we take the average annual income and we divide it by the average investment, or the average value of the investment. So when you do that calculation, because the average income is equal, because it's identical each year, if it wasn't identical, you just add them up and divide by 3. It's 63,435 divided by 212,500. That gives you 29.9%. That is less than the desired ARR of 37.5%, so you reject. So we're not gonna do this thing. Let's go to 10.10. Almost at the finishing line. So here we have a question about internal rate of return. So it says that Holberg Raisin Hotels AG, I don't know why all these examples are European, it's a bit colonial. Anyway, Holberg Raisin Hotels AG Resort Company is refurbishing one of its hotels at a cost of 7.8 million rand. The firm expects that this improvement will lead to additional cash flows of 1.8 million for the next 6 years. What is the internal rate of return of this project? If the appropriate cost of capital is 12%, should it go ahead with this project? So let's have a look here. So what is internal rate of return? It is the interest rate such that the net present value is equal to 0. And here they tell us the discount rate is, or the appropriate cost of capital is 12%. So how do we figure out what exactly the internal rate of return is? So really we just use a trial and error method so that we find a range within which the internal rate of return exists, and then we use interpolation. And I think in the memo they kind of do it, but not really very mathematically rigorously. So I'll show you guys how I do it. So let's try out I equals 12%. So we do the calculation. So we say net present value equals t equals 0 to n, sum of future cash flows in year t, over 1 plus 0.12 to the power t. So in year 0, we would just have the negative 7.8 million. And then we add, in order to get the other ones, because it's not a different cash flow each year, it's identical. So we can just use the, from our financial math, what we would use for an annuity. So you just do that calculation, 180,000 times 1 minus 1 over 1.12 to the power 6 over 0.12. If you're unfamiliar with that, I would just say go back and check your notes. I don't list to explain that thing from scratch. Like if you don't know that, you're probably a bit cooked for Friday. But anyway, you do this calculation. So negative 7.8 million plus 180,000 times that value, you get negative 399,467. So it's quite negative. It's not equal to 0. So that's not our internal rate of return. So let's try a different value. Let's try 10%. I'm not going to do the entire calculation. I think you guys are all smart university students at UCT. You know how to do it. If you calculate 10%, the value that you'll get is 39,469. If you try 10.2%, you will get negative 6,265. If you try 10.15%, you'll get 5,129. So we've got some important info. So we know that 0 is between negative 6,265 and 5,129. So that also means that the internal rate of return is between 10.15% and 10.2%. So now we're going to interpolate using what we get taught in stats. Shout out all the stats goats watching this, if there are any. So how do we interpolate? So let's arrange this in ascending order. So percentages, we have 10.15. X is what we don't know, so that's in the middle, and then 10.2. And then the value is negative 6,265. Below that is 0, because that's the internal rate of return that corresponds to X. And then 5,129, that's the positive value. So how do we interpolate? So I will say X minus 10.15. And so in the same breath, it'll be 0 minus negative 6,265. And then it'll be 10.2 minus X on the denominator on the left hand side, and it'll be 5,129 minus 0 on the denominator on the right hand side. So if you have passed grade 12 math, you will know how to do this because it's algebra, and so then you should get an internal rate of return of 10.1775%. And so I think the question that they ask you here is the appropriate, should it go ahead with this project? Did I actually finish concluding? So our IRR is less than the 12%. So likely we're going to reject this because, in short, that 12%, that discount rate, or the cost of capital, it just means that if we did something else, or maybe had a friend who has a secret Swiss bank account can hook us up with a nice interest rate, we could just put the money there. Instead of putting it in this project, we're only getting 10.1775% back. You could actually already, without interpolating that, you can conclude that the moment that you see that the answer is between 10.2 and 10.15%, both of those values are below 12%, so we would have known to reject it. 10.16. Here we're doing a question on payback criteria. So the payback criteria of Tempus, Fabriceer, and NV. Okay, they're evaluating two projects. They use a payback criteria of 3 years or less. So you must make your money quick. Project A has a cost of 912,855 euros. Project B's cost will be 1,175,000 rand or euros, whatever. Cash flows from both projects are given in the following table. What are the discounted payback periods and which will be accepted if the firm uses a discount rate of 8%? Whew. Okay, so we need to find the discounted periods and we need to decide which project is accepted. So you never let them know your next move. I'm going to start with B instead of with A. So that's just because as I was writing this out, I did B first thinking it was A, and then I was too far along ahead, so I just did B first. So in year 0, the project B costs us this 1,175,000. So that in year 0, that is our cash flow, that is our cumulative cash flow, that is our present value cash flow, and that is our cumulative present value cash flow. It stays the same. For year 1, they tell us that we have a cash flow. You can just look over here at the table. Here's your cash flows for year 1, for year 2, and for year 3 for project B. Okay, so year 1, the cash flow is 586,212. Year 2, 413,272. Year 3, 231,199. So let's have a look at your cumulative cash flow. So 1,175,000. We add 586,212 to that. So we add a positive number to a larger negative number. So the negative number becomes a bit less negative. And it's the same, 413,272 plus negative 588,788. You're left over with 175,511. That's negative. And then finally, when you add 231,199 to that 175,511, you get this value over here of 55,688. Okay, then we present value all of it. So hopefully by this point you guys know how to do that. So year 1, we take the cash flow in year 1 of 586,212 over 1.08 to the power 1. We take 413,272 over 1.08 to the power 2. We take 231,199 over 1.08 to the power 3. And then that gives us these answers over here. Okay, and we round it to whole numbers. And then the cumulative present value cash flow. So year 0, it's just that value, 1,175,000. In year 1, it is 632,211. And this is because we take the present value cash flow of 542,789. We add it to 1,175,000. So we take a positive number, we add it to a large negative number, it becomes less negative. We do the same. So we take 354,318, we add it to 632,211. That gives us 277,893. We take 183,533, we add it to 277,893. We still have a negative value, 94359. So we can conclude we reject this because by the end of year 3, you cumulatively have made, in present value terms, you have not yet made a profit. You have not yet broken even. Let's do project A. So project A, what is the initial cost is 912,855. Again, we carry that over in year 0 to our cumulative, our present value cash flow, and our cumulative present value cash flow, it stays the same. And the calculation is exactly the same. I'm not going to go through all the numbers, otherwise the video gets too long, but just pause the video, have a look at these numbers, make sure you understand how I got all of them. It's the same method as I did for project B. But you'll note that in year 4, we look at the cumulative present value of the cash flows. We still have a negative 14,873. So what does that tell us? It means we reject it, because by the end of year 4, like some European is going to be like, hey, have you guys made the money? You're going to say no, and he's going to be like, why are you costing us money? And he's going to fire you, and you'll go on welfare if you have your documentation in Europe. Anyway, thank God we are at the last question. I'm not particularly religious, but I like to thank God in case you never can be too sure. So the discount rate of this question, the company uses a 13.8% discount rate for its projects. Yes, let's try this. Kupio Sahatavara Keseteli Oi. I don't know why we as South African students are reading such names, but anyway, is evaluating 2 independent projects. The company uses that discount rate. Cost and cash flows are shown in the table. What are the net present values of the 2 projects? This one is pretty chill. So what are you going to do for project 1? You know that project 1 has a big upfront investment cost of 8,425,375. So that's this negative value over here. Then you take the future cash flow in each year, you divide it by 1.138 to the power that year. So for example, the year 0, we don't have to discount it because 1.138 to the power 0 is just 1. So that's why I've just taken it out over here and I've just put it over there. And then in year 1, we have 3,225,997. We divide that by 1.138 to the power 1, and so on and so on. So by the time we get to year 7, we have 1,365,882 divided by 1.138 to the power 7. And you add all of that up, put in your calculator, and then we decide to reject it. That's project 1 now. Then project 2, we have an upfront investment of 11,368,000. Same process. We sum up the future cash flows in year T. So we go from T equals 1 to N. I've removed the negative 11,368,000 from the sigma, because remember, when we discount it, it's just the same as dividing by 1. So you can just treat it as a number on its own without this. I mean, you can discount it, but it just means you'll just divide by 1. Then you add all the other discounted values, so like 2,112,589 over 1.138 to the power 1, all the way up to 4,556,424 over 1.138 to the power 5. Because this is positive, we will accept the project. Okay, what is the time now? It is 2:24. I really do apologize if this video ends up being too long. It took me quite a bit of time to prepare, but I do hope this was beneficial. I've had a look at the week 6 tutorial exercise. It doesn't seem to be a lot going on there. So I would say this covers the bulk of the calculations that are required from us in week 6. So thank you guys for watching. I hope it was informative, helpful, whatever. If you liked it, please comment and tell me how much you liked it and how cool I am for doing this. And like the video and subscribe to my channel, and share my video. And yeah, if you ever see me on campus, give me like 1,000 rand to say thank you. I don't know. Anyway, thank you very much for watching, guys. And then you guys can stay tuned for week 7 tomorrow.